Good morning, y'all. I'm Sabinal,
I'm Jeff Booker.
and today we're going to talk about our financial analysis on 15 different companies in 3 different sectors. What sectors do we have, Jeff?
We have semiconductors, technology, and industrials. So we're gonna break down the semiconductors first.
So with semiconductors, we decided to choose Taiwan Semiconductor, NVIDIA, AMD, SMCI, as well as QCOM. So Taiwan Semiconductor is one of the world's largest dedicated semiconductors manufacturing chips for major tech firms such as Apple and NVIDIA. Their headquarters are of course located in Taiwan. They also play a critical role in the global tech supply chain. Its scale and process leadership and advanced nodes make it a foundational force in modern computing. NVIDIA, one of the top growing companies right now, designs GPUs using gaming, AI, data centers, and they're making it a key player in the acceleration of computing. The company has rapidly expanded to AI, automotive, and enterprise solutions, and innovation is parallel as well. AMD produces CPUs and GPUs in enterprise markets, competing with NVIDIA. Of course, NVIDIA, the company has gained significant market share with Ryzen EPYC processors and is known for balancing performance with cost, efficiency, and high demand sectors. SMCI has seen a ton of growth potential in their stock last year. They provide high performance servers, storage solutions for cloud computing, AI, and enterprise data centers. The company really emphasizes energy efficiency, customizable systems, and it benefits from rising demand in AI infrastructure buildouts. QCOM, a global leader in wireless technology, they produce mobile processors, 5G chipsets. Its Snapdragon platform powers billions of smartphones worldwide. The company monetizes its vast patent portfolio through licensing and chip sales. So here's some of the ratios. We got their short-term solvency ratios, their current, their quick, and cash. As you see, they're not too heavy on inventory or too heavy in cash as well. They look really good as far as that goes. Some of our favorites for that will be NVIDIA, as they have really, their risks are obviously, of course, higher. So for ROE, we kind of broke it down into ROE, ROA, and their equity multiplier. I think it's really important to see where these numbers are derived from. So with NVIDIA, they had a pretty constant growth. They had a drop off in 2023, but a really sharp rise in the ROE. So we try to look at that and kind of break it down. And we thought maybe it came from their leverage. Well, honestly, the leverage is lower than some of these companies, and it's only 1.64. When we look at it, it's showing a ton of potential and growth still, and it showed a lot of potential from 2023 to 2024. If we look at the other companies, equity multipliers, they're all relatively not high. They look really well. So when we go into the next slide and see what's really driving it, the total asset turnovers and profit margins. I mean, really, NVIDIA is just blowing it out of the water with their profit margin when we look at it. TSM, one of the global producers, is also really high. So when we looked at both of them, we wanted to see which would be the best as semiconductors. And the total asset turnover, NVIDIA just blows it out of the water again with having a higher asset turnover. And you're looking at these charts, we see the really sharp rise from 2023 into 2024. And then economic value added, as you see, they positively added a lot of value to their company, not being negative like AMD or Taiwan Semiconductors. And with their PE ratios, although relatively high, not as high as AMD like we see, they're still showing a ton of growth to the marketplace. And I mean, we see more growth in their stock as well. When compared to AMD 105 compared to their 50. So that's pretty big. And the economic value spreads, just showing just their value, what they're bringing back to their shareholders. It's been great. Since, like again, when I bring up 2023 to 2024, the rapid expansion has been insane, and it's also shown in the growth in their stock. Long-term solvency. So when we look at their total debt ratio as well as their tier, NVIDIA has no problem paying off their debts to the creditors. No problems. They're all relatively small when you look at AMD, SMCI, and QCOM. But TSM and NVIDIA have been some of the top ones that we were looking at here. As you can tell from their ratios, I mean, they have no problem paying off their debts, and they have no problem with holding cash, and even their ratios are relatively low as far as what they're doing with that.
All right, so now we got the industrials. So we're going to be looking at Lockheed Martin, United Rentals, Caterpillar, General Electric, and then RTX. They're formerly known as Raytheon. So starting off with Lockheed Martin, they are a leading defense contractor specializing in aerospace missiles and security systems. It's a big defense company. Derives a majority of its revenue from the U.S. government contracts, and one of their flagship programs was the F-35 fighter jet. Next, we've got United Rentals. They're the largest equipment rental company in North America. They are in construction and industrial markets, and they benefit from infrastructure investment and cost-saving trends. And then we got Caterpillar. Caterpillar is everywhere. They're a global manufacturer of construction and mining equipment, engines, and power systems. They are the pinnacle of what everyone, like United Rentals, all those other companies, try to emulate. And we got General Electric. They've been around forever. They operate in power, renewable energy, aerospace, healthcare. They've kind of got their fingers in everything. They focus on the core industrial strengths such as aviation and starting to get into air. And then Raytheon, another defense company. They're mainly in aeronautics, so they're all jet engines, avionics, and they are a commercial aerospace, and they have clients internationally. So here are their short-term solvency ratios. They all seem to be pretty good. They're, for the most part, they're about even on their assets to liabilities, their quick ratio. Some of them are holding a good bit of inventory just because they're defense, defense, and they're renting out a lot of equipment, so they do have to hold on to a lot of inventory. And in their cash ratio, they're holding on to a lot of cash as well. Or sorry, not a lot of cash. And right now, we're going to look at some of their profitabilities. So their ROA, they're doing. Everyone's pretty good on there. No problems in any of these except for Raytheon down here. They all have really good ROEs. ROAs, they seem to have pretty decent managers. However, a lot of them have a decent amount of debt. As you can see, everything's over 2 times leverage. So, but that's pretty standard for the industry just because they're big equipment, lots of travel, things like that. Not anything out of the ordinary. Here's the profitability. So the profit margins are all really good, except for worried about RTX and Lockheed Martin, but everything else seems to be doing really good from a profit margin perspective. And because it's more services for the most part, there's not a services in the United Rentals and CAT. They're not really not turning over their assets because they are renting out a lot of services and things like that. But Lockheed Martin, they should be turning over a lot, but Raytheon has seemed to have been falling behind in that realm. And then here's our economic value added. For the most part, CAT, United Rentals, and Lockheed Martin are the only ones that are actually adding to their company. GE and Raytheon have been kind of falling behind. Price to earnings ratio, they are giving back to their investors. And for the most part, their price to book ratio is looking pretty good. And then here's kind of their spread, and then their enterprise values. So, obviously, Raytheon is leading in that realm, but there are other factors that are a little bit concerning for them. Now, their long-term solvencies, They all can cover their debt relatively well, especially Cat. Cat really excels in this one. This is, my opinion on my favorite company out of here is Cat, just because they don't have any issues covering their debt, where it seems like some of the other ones might. And then technology, we're going to be looking at Microsoft twice apparently, Apple, CRM, and Oracle. So Microsoft, they're a global leader in software, cloud computing, and enterprise services. Its Azure platform, Office Suite, and LinkedIn are also key growth factors. The company benefits from a diversified revenue model and strong recurring income streams. Palo Alto was the other Microsoft. They're cybersecurity offering cloud-based services. They're also working with AI and detecting threats through there, and they're expanding very rapidly in their realm. And then Apple, everybody knows Apple, consumer electronics, software, and services. They are long-standing customer service and loyalty, and they always maintain a strong balance sheet.
And we've got CRM. Salesforce is a leader in customer relationships. We see this a lot with a lot of sales companies. Cloud-based business applications. Its platforms really help companies manage sales, service, marketing, analytics. It's also actually expanded into AI, which we have seen in many companies that are starting to develop that a lot more through Tableau and Slack. Oracle is a legacy enterprise software company. They're really transitioning toward cloud-based data services. This cloud infrastructure is gaining traction with a lot of large enterprises. And Oracle's strength really lies in its long-term enterprise contracts and mission-critical systems.
Yeah, so here's a look at their short-term ratios. They're all pretty decent. Again, just kind of like the industrials. For the most part, they're about 1, except for Palo Alto, Apple, and Oracle. They've got a little bit more liabilities than assets, but that's all right. They're holding on to a lot of inventory. Or not holding on to a lot of inventory. They seem to be getting rid of it quickly, but they are holding on to a lot of cash.
And ROA, we're breaking down. We see a really good ROA in between Apple and Microsoft, as well as Palo Alto, all relatively high, especially when we look at the chart. And then we go into the ROE, and we see a breakthrough with Apple at 157. I mean, it really blows most of their competitors out the water. But also then we have Oracle, which unfortunately we didn't have the data for 2023 and 2022. We do see that it's pretty consistent as far as these two go, and the number is 214. It's really high. But we decided again, let's look at the leverage. What is really driving these numbers? And we go down, Microsoft being one of the lowest with CRM, and Oracle with that high number, they have so much leverage. It's obviously driving that high number. And then we look at Apple at 6 compared to 28, but yet a relatively high ROE. It's a no-brainer.
And so looking at their profit margins, it's relatively consistent between Microsoft and Apple. Microsoft and Palo Alto. Anything above 20 is kind of the metric for this industry that we're looking for. The Apple, Palo Alto, and Microsoft are looking really, really good. And from a total asset turnover perspective, Apple, everyone seems to own an Apple, they are constantly turning over their assets at a 1-to-1 ratio. Here's their economic value added. Apple clearly stands out in this industry. They've added $74,000 to their company, and as you can see, a few others are falling behind. And their price to earnings ratio, there's going to be a lot of growth, especially with Palo Alto. They're supposed to be a leader. However, they've had a steep decline in the past few years, which is a little concerning.
So when we look at their debt ratios, we see that the total debt ratios with Apple is a little bit higher, and their tier. Unfortunately, again, we don't have the data for these two, but Palo Alto can cover their debts at least, as well as most of these all 5 of the companies that they can cover their debts. In the past year, Apple's been able to easily cover their debts as well, and Oracle too. Even with their high leverage, they're still able to cover their debts. So no real red flags there. And then here's our top 3 picks. We have NVIDIA, Cat, and Apple that were currently our favorites in 3 different industries. We just wanted to do a quick summary as far as comparing the 3 different companies together with their current quick and cash. And we can see that, we can see with their quick ratio that they're pretty different when it comes to the inventory. We can also see that NVIDIA is still kind of a leader when it comes to these ratios.
And same thing with also kind of looking at ROE first is the first thing we'll look at. Apple is a clear standout in this realm. However, NVIDIA is not far behind. And if we look at their leverage, Apple has taken on a lot more debt than NVIDIA. Yet, if we go back to their ROEs, it's only 30% behind Apple, but they have 6 times less leverage than they do. And they're looking at their profit margins. Obviously, NVIDIA is a huge standout. They're a big software company. They don't have lots of physical products, so they can kind of cut down their costs through that. And then their total asset turnovers are all pretty consistent. There's nothing falling behind here.
And then economic value added, we see that NVIDIA is also, still quite the leader when it comes to this. You can even see on the chart, the difference is uncanny really as far as a comparison to these companies. And then when it gets to their PE ratios, they're all relatively the same, I'd say. I think they're all 3 great companies to invest in. Even NVIDIA is still showing a lot of growth potential with their projects that they have going on. And then we go over here to our top pick. It will be NVIDIA, of course. Analysts' sentiment remains positive with a consensus of moderate buy. The stock as of right now is trading at 116. It's about, I want to say, $40 from the highs, which isn't too bad. I think it is a great buy. What about you, Jet?
Based on all their ratios, I see a lot of growth, and especially with a big, what would you say, more attention towards AI. I can see the stock becoming a huge player in the markets in the next 5 to 10 years, especially as we navigate this AI landscape.
Yeah, and so with that, we definitely agree with all the analysts. Even before doing it, we were both biased and not buying NVIDIA. But after looking at their numbers and seeing what drives their growth, we can see that even just from 2023 to 2024, they've had rapid expansion, and it's looking like a great company. And that right now is a good buy that dip scenario. Of course, not investment advice, but it's a great buy. Thank you.
And thank you.